Hello and welcome back. Thanks for watching. Thanks for tuning in this week. And thanks for all the comments that you give every week. I do read them all. I can't respond to them all the time, but I try to get to as many as possible. So before I get into the CPI data and the July stats from CREA, I just want to talk about some conversations that I have with buyers where they've been advised by just random people, uncles, parents. Parents are actually always saying this, and neighbors even. I just had a conversation with someone, their neighbor told them to get into the market. Whether it's expensive or not, they say it doesn't matter. Just get in because over the long term, it'll be worth your while. And if you're going to be in it for 10 to 15 years, you don't have to worry. And there's no real data to back this up because I quiz these people and they say, well, what happens if you're not in it for 10 to 15 years? Or, you can just buy anytime. It's just a consensus because these people are usually older and they've made money or it was a good investment for them. Prices always go up and whatever else. That's the theory, right? But I would like to argue that it's not always the best case scenario, especially when you buy in a bubble or near the peak of a bubble. And let me show you why. So looking at this chart here, you can see, yes, prices always seem to go up, right? They did go down a bit there, but in general, they go up. So yeah, it's a safe bet, right? Just get into the market and be in real estate. Mind you, your payment will kill you and you'll be a debt slave. But regardless, this is the conversations that some people have with their children and with younger people. It's usually the older people talking to younger people, where I do think real estate is a great long-term goal, but getting in at the wrong time can be catastrophic and deem your life very miserable. But let me just go through some charts here, or this chart, a couple of different things on it. So back, I've circled two circles. The one on the left is if you had a bought, and this was the last bubble in the 80s, end of the 80s, 89 or so. Look how long it took for prices. Prices went down after that, and it took that long, almost 12 to 13 years for prices to come back up to the peak pricing that it was at in 1989. So 12 years in the market and you're just breaking even, probably losing money after all the maintenance, land transfer tax, and commission to sell your place, lawyers' fees, all the rest of that. So you're actually going to lose money. You would need to be probably 13, 14 years in the market to truly break even. And again, you paid all that interest on that debt too. And what would happen if you needed to sell 5 years after purchasing? Well, you're going to be losing money. And it doesn't look like a lot of money on this chart, but it was a lot of money back then. It was big losses, and it would have probably left you in a very precarious financial situation. So again, entering the housing market near the peak of a real estate bubble is very risky. You will literally be stuck in that house for 10 years plus unless you want to suffer a loss and you decide to sell it. So it's not about time in the market a lot of times. It is about timing the market, and you just don't want to choose the wrong time. You have lots of times to enter, but to make sure you don't choose the wrong time. Another conversation or statement I hear, now I haven't heard it in a while, probably 6 months to a year, and of course that's because prices haven't been going up, is real estate doubles every 10 years, or you can count on real estate doubling every 10 years. So I've taken the same chart here, and again, I've used this data because it's a wide amount of data. This covers about 25 to 30% of all sales in Canada. So I have access to this data. It goes back to 1988 or so, and this is why I'm using this. I wish I could use the national data, but it doesn't go back that far. So in the green there, prices doubled. So this is the time frame when if you had a bought in that time frame, your prices would have doubled. Of course, we can't go past July 2014 because we're in July 2024 right now. So we don't know what's going to happen. But they stopped doubling at about 2012, 2013, and now they're not doubling. It's going down, actually, that ratio of doubling, or down to about 85% now. So it's still a great return after 10 years, 8.5% a year or so. But yeah, that was the section then when you had a bought in the last 30-year time frame preceding 2014 or so, it would have doubled in price. But let's go back to the bubble. Look at the people that bought there in the red. They bought around the peak of that last bubble in the late 80s, early 90s. And prices were less than or equal to the purchase price 10 years after. So they were 10 years, they were either going to lose money or break even at best. So again, it just goes to show you prices don't always double. And you do run the risk of losing money in the medium term. And we're talking 5 to 10 years. If you sell after a bubble, you're probably going to lose money if you bought near the peak. And just one more chart here to kind of put the real estate investing thing into perspective. This is from the US, but you can look at Canadian stocks, the TSX, gold prices in Canada, and they're all going to be relative here. And this is the growth of $100 by asset class. And of course, cash is the worst. And I guess that would be a cash savings rate that they're doing that at maybe 1 or 2%. But then real estate's just above that. It hasn't performed well compared to other asset classes. Government bonds pay better, gold pays a lot better, corporate bonds pay even better, and of course the S&P 500 has outperformed by a long shot. Now on to inflation. So it just came out today, so I added it in the video last minute. Here it is, the Canadian CPI or CPI, whatever you want to call it, 2.5%. So it dropped substantially. I think they had it at sticking around 2.7, maybe 2.6. Some have had it, but I think the general consensus was 2.7%. And we're down to 2.5. And you're going to see all the news headlines, lowest CPI in 40 months. Well, look at this chart here. 40 months brings us back to 2021 or so. It's still on the high end of normal. When you look historically, 2% is the normal. So we're still above the average or the 2% target range. But of course, everyone's out there celebrating. Now, looking at shelter dropped, and shelter was the main reason this dropped. So it dropped from 6.2% year over year to 5.7% in July. And that was a big reason why the inflation data came in lower. And you can see it here, deceleration in headline inflation led by shelter component. Now, personally, I don't see the cause for celebration when shelter in general is costing 5.7% more than it did last year. That's a pretty significant increase. But let's break it down to the main contributors here to that shelter or to the CPI, which was 2.5%. So you have the shelter right at the top, mortgage interest costs, 21% more than they were last year on average. That's a huge increase. Rent, 8.5% more than it was last July. Then, of course, food is still up from restaurants, 3.8%. Insurance is up, and property taxes and other special charges. So, of course, 4.9%. That's part of shelter, too. So, when the politicians and the media are celebrating a 2.5% CPI number for July, I don't consider that a good thing. I would like to see a negative 2.5% for consumers at this point, but nobody likes deflation, so I won't go there. And while we're on the subject of inflation, here's a chart. I broke down the national house prices or national residential prices in Canada, and I put them in nominal terms like I normally do. We're at 667,000 for July. And of course, the real prices adjusted for inflation with the base year of 2005. So adjusted for inflation, the real CPI numbers that they give us right from the Bank of Canada, this data came, we should be at $441,000 for the average house price. So that's a big drop from where we are, $667,000. Now moving on to the national statistics from July. Actually, I just went over this on Video Market Mania, some of these charts, so check him out to see his take on them. It's a really good conversation, but let me just go through them quickly here. This, I thought, was a really interesting headline or statement by the Bank of Canada economists here, and I'll read it to you. With another rate cut announced on July 24th, we've now seen 2 rate cuts in a row, and the expected pace of future policy easing has steepened considerably, with markets now anticipating rate cuts at every remaining Bank of Canada decision this year. Combine that with a record amount of demand waiting in the wings and the forecast for a rekindling of Canadian housing activity going into 2025 has just gone from a layup to a slam dunk. So this senior economist from CREA thinks there's going to be a flurry of buying activity next year because interest rates have come down and whatnot. I tend to disagree. If there is increased buying activity, it's going to be because prices come down. Prices need to come down with interest rates. Everyone's focused on rates, which is insane. Interest rates don't make houses affordable. They make the payments more affordable for a certain period of time, usually 5 years. But true affordability comes from lower house prices and manageable rates. So drilling down into the data for July, here are some more numbers. The average price in Canada dropped 29,000 month over month, or 4.1%, pretty significant decrease. But again, we did have a 95% chance, if you watch my other videos, of prices declining into the summer. And it was a $1,000 year over year decline to 0.1% from last year. And from the peak, we're down $148,000 or 18.2%. One other thing I wanted to point out, put things into perspective, we are right now at $667,000 for July 2024. This number is lower than February 2021 when it was 676. And this isn't even the lowest price we've had since this real estate downturn. So we're actually now lower than we were in February 2021, which is pretty insane. 3.5 years and prices haven't moved. And looking at the sales for Canada, the total sales, we are 6.5% below the long-term average. And I've said it many times, they couldn't have really got much lower than they were for the last, 6 months to a year or 2 years, whatever the case may be, 2023 and 2024, and especially with the increased population. So sales per capita are probably the lowest on record, but they don't track that statistics. Sometimes I do it in my charts. So again, stay tuned, and I'm sure you'll see it in here sooner or later. Months of supply, good news for buyers. Months of supply has been increased a lot over July last year, 2023 to 2024. You see a big uptick in the months of supply. We're at 4.2 months right now, and that is pre-pandemic levels almost. July 2019 was 4.7 months of inventory. So we're not far off of that statistic right now, which is, again, great news. We need supply. Doesn't matter if you're a buyer or seller. We need months of supply to increase about 4.5, 5 months so we can get a healthy, balanced market. This chart I've shown previously, I did just update it, and this is the correlation or the inverse relationship between the average house price in Canada and the months of supply. The months of supply is in the red there on the top on the left-hand side of the screen, and you can see we were always sitting around 6 months or so, and prices, trended up like they would normally over time. And once we got to that 4.5 or so, that's when things flipped. That's when prices kind of get out of whack. You see it there. There was a big spike in 2017, right in the middle of the chart there. And that was because months of supply dropped down. And of course, the price spiked. But there were some interest rates shuffling around then. And once the months of supply picked back up, prices went right back down. So it seems like that 4 to 5 months of supply is a key target. We've been hovering around 4.2 or maxing out around 4.2 for the last couple of years now. And this is why price has been trending sideways. Now, I did draw that yellow line on there. That's about 4.5, 4.6 months of inventory. Once we hit that, this is my estimate, my forecast, I guess you could say. Once we hit that, that's when you're going to see some pretty decent downward price movement, which is going to correlate with recession and all the rest of those things that we call for, that I've called for in my forecast. But again, that yellow line is important. Stay tuned. We haven't reached 4.5 months of inventory since 2019, and I think we're going to reach it in the fall. But again, it is a big key indicator. Inventory, supply and demand does matter, and it's trending in the right way. So let's see what happens in the future with that one. Couple of charts here just on affordability. This is a chart showing the monthly mortgage payment on a average Canadian home. And you can see I put a trend line in there. We're, of course, way above where we need to be. The average monthly payment's about $3,400. If you go back 10 years, now let's talk about affordability here. We're 2024. You go back to prior to 2015, it was like $1,400 a month. So we have more than doubled in the last decade for the amount that someone's paying on a monthly mortgage payment, which is insane. Now, it is going to come down and come back to where it should be, that historic mean, but it's going to take not just interest rates. Everyone's focused on interest rates. I keep saying it, but it's going to be a combination of interest rates coming down and house prices coming down that's going to truly bring back affordability. Similar kind of chart here, but this is the first year interest payments. So interest payments only in the first year when you enter the housing market. And of course, look, it was like six or $7,000. I think it was maybe closer to $7,000, the long-term average. And now look at it; it's like over $30,000 in the first year. Canadians are paying on their first home, which is insane. Even if I took the last decade, including this big spike, it was like $12,000. So we were way above the norm. And looking back even to 2007, 2008, when we had our last mini bubble in Canada, it was about 12,000, 13,000 or so. And of course, it dropped right back down to under $5,000. So right now, it's just way out of whack. This is not normal to be paying $30,000 interest. We were actually paying $34,000 at one point. But again, it needs to come down. And of course, we know how that's going to get there. Prices and interest rates got to drop. And lastly, just a quick update on August. This is from the Toronto Real Estate Board. So again, 25-30% of the Canadian market right here. They are down 3% so far in the first 20 days in August, $26,000 month over month from July. So yeah, we're seeing those summer price declines like was forecasted, 95%, actually 100% chance that if you remove 2020 COVID. But prices always decline into the summer, and this year is no different. Anyway, thanks for watching this week, and I'll see you next time.